that's good with you.
Yeah.
All right. All right, so it looks like we are live. I just want to welcome everyone to the stream. Tonight we have on Moki Finance, just to kind of talk about, his investing strategies and kind of his thought process through his investments. And we'll just kind of try to get an idea of where his thoughts are when it comes to that. So you can just kind of introduce yourself however you like, and we'll go from there.
All right. Thanks, Frank. Yeah, my name is Moki. Run a finance YouTube channel called Moki Finance, for those of you who are not familiar with it. My background, I guess, is not in finance. I got my business degree in 2012, a general business degree with a minor in international business and entrepreneurial studies. Kind of always wanted to be my own boss. But when I graduated in 2012, there was not a lot of jobs available coming out of the great financial recession that was 2008, 2009. So I, did the typical corporate ladder, retail management, and even became a truck driver at one point and drove a big rig for 3 years. And then finally, I got back into the field that I wanted to be, which was financial services. And then fast forward to 2018, when I realized I had a money problem. I was making a lot of money, $150,000 a year, and I was spending like $170,000 a year. So I was digging myself a hole that it was just getting bigger and bigger. And finally, I lost my job in that summer, and I found through another fellow coworker at the time, I found Dave Ramsey, which I know some people might believe in or might not. But this was me brand new in 2018, not really knowing anything about money. I found Dave Ramsey and decided to follow his baby step program to get myself out of debt. And I did. Me and my wife, we paid off $87,000 of our debt in 12 months. So, of course, we're high income earners, so it's easy to do that when you make a lot of money and when you decide to sort of budget and live intentionally versus just throwing money left and right. So I became debt free in June of 2019. And since then, I turned off the debt repayment spigot and turned on the investing spigot. And I've been investing heavily into the stock market. When I started this journey, I had a negative net worth of $14,200, and now my net worth is north of $350,000 in a very, very short amount of time. And I did not win the lottery. I did not win a big inheritance. Did not pick a stock that 10x'd. I didn't do any of that. I just simply saved a lot of my money. Most years, over 50% of my income was saved, and it was invested in low-cost, broadly diversified index funds. I'll get into later on those 3 funds that I typically recommend, or 3 indexes that I recommend. But yeah, that's how I've done it. And I like to preach that everybody can follow what I've done and replicate it. Not the numbers, but you can replicate the success. It just might take you longer depending on your income or not. But, being debt free, not using debt in the future or borrowing any kind of money, that includes credit cards, and investing for the long time, not investing for the next 5 or 10 years, but really investing for the rest of your life. And when you have that kind of mindset, I think it's very hard not to be successful. I almost can challenge that if you use that mindset, very few people will not succeed. And sometimes, it could just be bad circumstances or something in life that happened that, of course, was unforeseen. But for the majority of people, they could become successful financially.
Yeah, I think I definitely agree with that. I guess I'll just ask about the credit card thing. I know that's like something I heard you talking about recently.
Yeah.
I guess just like what your thought is on that. Like, obviously, I use a credit card, and it's important to pay it off every month and stuff like that. But I can also understand the other side of that. So what do you think about that?
In my life, I've been on both sides of the aisle. I've been on the side where I've been using credit cards for the first half of my life, and now the last 4 years I haven't. So I can kind of speak from both perspectives, which is pretty unique. I think a lot of people either are users or not users, right? It's very hard to find somebody who's done both and can stick to one at the end. But in college, my first credit card was in college. I remember on campus they were giving out free hoodies, and if you sign up for the credit card, I said, why not? I want a free hoodie. It looked like a cool hoodie. And the first time I used it was I bought some books. I said, well, I'm short now on money. You know how it is in college. I'm not sure if you're in school or not, but we're living the college lifestyle. It's you're very, very, very frugal lifestyle. You're living off ramen basically, and drinking cheap beer. And I said, well, I'm short on money. I'll buy these books on this credit card and I'll pay it off on my next paycheck. Cause I did work a 30-hour a week job in college. And I did that. But then instead of just buying the books, some other stuff came up and I bought other stuff. Anyways, when I graduated, I had $6,000 in credit card debt. Luckily, I didn't have any student loan debt, thanks to my parents, and me kind of working together to make sure that tuition was always paid. But I graduated with credit card debt, which is pretty unique for a college kid. Maybe not these days, but it was back then. And from there, the credit cards progressed to using those cash back reward credit cards, trying to basically play with those categories and make sure I'm getting the maximized amount of cash back. And I got to the point where I actually did pay off the credit card debt. And I was just like you, paying month to month. But what I learned in 2018 when I lost my job is that I overspend on credit cards without even knowing it. And it's the easiest way I can explain it is if you go to the store with I actually got cash because this is what I primarily use. But if I go to the store with this, and I can only put this much amount of stuff in my cart. And if I go to the store with a credit card, I could really put a whole bunch of stuff in my cart because I can spend up to the credit limit. And that's a psychological thing. And I learned that I overspend, and not just me. As a financial coach, I work with a lot of people who overspend on credit cards, and it's a big problem. And some people, actually most people, I think 90% of people use credit cards. So it's like you're in the minority if you don't. But most people will not admit that they're in credit card debt when in 1 in 2 people are. It's like a $1 trillion debt right now, the credit card industry. Most people will tell you they only buy the necessities on their credit cards, like food and gas, when in fact that's not what they're doing. So it's a psychological thing. And when I cut up the credit card, I felt like I burned a bridge because it was always like, well, it's there for emergencies. If I screw up something in my financial life, I can always put it on a credit card. And now the way I live my life is obviously by paying off debt, I have a lot of cash. So I actually have my own credit card that I created, which is a debit card. Separate from everything else that I use. It's like a second checking account that's not linked to anything else. And I load up in there how much I'm willing to spend. And once I spend it, that's my credit limit. I'm up to that and I can't spend anymore. And it just forces me to stay in line with the goals and objectives that I've set in my budget and that I've set for myself on how much I'm willing to spend. And it works. And I try to teach people about it, but it's a very difficult thing because I don't know if it's the cash back or if it's the protections from a credit card, but people think that you need a credit card to make purchases, and you really don't. I've rented some really fine hotels in Mexico and other places in Europe. I've rented cars. I've never, except one place I did run into an issue, but I chose not to, given my business either way, because they wouldn't allow me to stay there without a credit card. But, it's an alternate lifestyle, but it's a lifestyle where you're in control. And I just feel like a lot of people are not in control when they spend with a credit card. And I've been very active on YouTube talking about credit cards, especially on my podcast. I talk about how bad they are. And I wholeheartedly believe that. And I think most people just don't want to admit that they're bad with credit cards. Even, everybody, what's funny is on the internet, everybody is an expert, right? Everybody is so good. But it's pretty fake. You can easily, when I've challenged a lot of people, I said, well, send me your statement, because I read statements for a living. Send me your statement and I will find you $500 in overspending on your credit card. And nobody's taking me up on the offer. So if anybody is in here tonight that wants to take me up, you guys are more than welcome to. But I guess the long-winded answer is you overspend on a credit card, which you can't do with cash or a debit card when you put in place the systems that I use, where you really limit yourself to how much you're going to spend.
Yeah, I could definitely see that like happening easily. I guess
And
for me,
you're young though. So Frank, once life kicks in, man, For example, I don't know, once you get married and have a family, there's a lot of unexpected stuff that's going to come up. And if you just keep putting it on a credit card, putting it on a credit card, putting it on a credit card, eventually it will run away, unless your income can keep up with it. But yeah, curious to
Yeah.
hear your take from a young guy's perspective. What does the
Yeah.
credit card offer you that you think that you'd be missing out if you just use a debit card or plain old cash?
I mean, I guess to me, it's like the thing that enables overspending to me, or the possibility of that, I guess, is just the electronic nature of it. But
Mm-hmm.
that's essentially the same in like a debit card per se.
Yeah.
So just the ability to be able to like buy something like that quickly from anywhere in the world, right? Um, that's to me is like what sort of seems like, enables you to, overspend and not be as thoughtful about your spending, I guess.
Mm-hmm.
Um, but I don't know. At this point, I feel like, there's not really much I need to buy anyway. So,
Yeah. So you can't really
maybe
get in
that's
trouble.
part of it as well. Yeah.
Yeah, yeah. I think once you're on your own, and I mean, I got in trouble in college when I was still living in my parents' basement. But once I got on my own, that's when I really got in trouble with the overspending and, packages showing up at my door every day and just a bunch of mindless stuff that I couldn't tell you where that money went. And, reviewing my credit card statements, which a lot of people don't do that. And I didn't do that. I never cared to, obviously I had the text alerts in case there was fraud, but I never really reviewed my statements to see what I bought, what categories I was buying. Even though the credit card companies made it really easy, they like had these fancy statements, and
Yeah.
all I cared about was the cash back amount. And it's a flawed game because the more you spend, the more cash back you get. But that's counterintuitive. It should be the less you
Yeah.
spend, the more you have, right? So it's a flawed system in my opinion. It could be used as a tool. I'm not going to say it can't, but most people use it incorrectly and they get themselves in debt. And from there, it's a tough hole to dig out of. The interest rates are astronomical. I mean, astronomical, 22-28%, depending on your credit score. And it's uncollateralized debt, so it has to be that high. And I don't know, it's not a good wealth building tool in my opinion. There's so many other options that I think it's one that hinders a lot of people. But to each his own. I know most people won't agree with me, which is fine. Everybody has their own opinion, and I think everybody's entitled to their own opinion.
Yeah, I agree. I guess, what do you think of the like uh, credit score aspect of that?
Yeah. So coming from a guy who had an 825 or 830 almost credit score, I'm in the camp that your credit score doesn't determine anything really, except that you like debt. It doesn't take into account what your net worth is. It doesn't take into account how much cash you got. It takes into account how much money you borrowed. Have you repaid on it? And in 2018, when I had that great credit score, I was able to get 0% car loan rates, right? Which is pretty cool. I was able to get low interest lines of credit because I had a high score. And even now, when I just closed on this most recent property, I was able to get a really low mortgage interest rate on my property. So the aspects of borrowing money for cheap with a high credit score makes sense. But then at the end of the day, for me, borrowing money on a car or on a personal loan or a line of credit or on a home equity line of credit, it doesn't make sense in the long run because you're going to have obligatory monthly payments that you're going to have to pay back, which will come from your paycheck plus the interest. And instead of saving that money and investing it, you're throwing it away essentially to the banks and the lending institutions that gave you that money. So it's difficult to live without a credit score. I'll give you that. Mine's been dropping ever since. It's not, I think it's like average now 680 or 690 because I don't use it. But eventually, I know it's going to go to zero because it's not going to be determined once all the credit lines are closed out. I still have the mortgage, so that's kind of keeping the payment history alive. But you know, outside of borrowing money for a mortgage, I don't think you need credit because they'll get you in trouble. Even the 0% car loan rates while they sound good on paper, you still are buying a $20, $30, $40,000 car that you're paying back over 72 months. And when you just think about investing that versus putting it in a car, which is going to go down in value. I know today cars are now dropping like rocks, but in the past they have, and in the future they will continue to drop like rocks. They go to zero. Every single car you buy is going to go to zero. So when you think of it from an investing standpoint, what's the purpose of having a good credit score to borrow money outside of the mortgage? There really is none, because the opportunity cost of that money could working in the stock market is much, much higher, in my opinion.
Yeah, I think that definitely makes sense. And I mean, I think there's room for, a lot of things to work for different people. It's kind of like whatever works for you is kind of good with me. So
yeah, of course there is. But at the same time, I think from my perspective, being in debt, knowing how I was one income loss away from filing bankruptcy. Like if I lost my job and I didn't get back on my feet and got a second job, I still had those monthly payments waiting for me, right? So I'd be in a lot of trouble. And that's where I come from. I come from the perspective that if you don't have that stability in your finances, you shouldn't be playing around with debt, because you're gonna be one wrong move away from losing it all. And debt allows you to do that. You could leverage other people's money, and it sounds great when it works. And I know I saw a lot of it on YouTube in 2021, people using margin to invest, buying things like ARK and Tesla. Sounds great. But nobody's talking about how they're being margin called when their investments go down 50%, and then they don't have the cash to cover the margin call. So now they have to sell their investments at a loss. I think it's all great and dandy, but there will come a time, and the time is now for a lot of people, where bad money handling gets exposed. And what's that saying? I don't know if it's from Warren Buffett or who, but you can tell who's skinny dipping when the tide goes out. And you really start to see bad financial moves that were made by people that looked like geniuses because they used other people's money get wiped out. And it's happened time and time again. And I guess I want the security of knowing that even if the stock market falls, God forbid, 80, 90%, I can't get wiped out because I don't have any debt. And I'll still be holding and buying more because I'm using my own money. And it just gives me a sense of peace of mind that I think a lot of people could benefit from having, so that they're not so stressed out about their finances when times get rough.
Yeah, I think that's definitely a valuable piece, is like having that, I guess, peace of mind and security. And
you don't need it at your age. You can,
yeah, exactly.
You can take all
that's
the
what I was
risk you
about to
want.
say.
Yeah.
Like,
so it's a
different people.
It's a perspective thing. So when I was 20, I mean, I wasn't investing or anything, but I paycheck to paycheck was fine, and being in debt is fine. But now, I have a family, I have a young kid to feed, and God forbid, I'm in all this debt and lose my. I don't work anymore. I only do this things for myself. But that's another reason, being debt free is kind of cool. You can choose to not work at times and still be okay. I quit my job in March of 21 and haven't gone back to work since. And I'm still living, still breathing, still eating, still kicking, because I live on such little. It doesn't take a lot to pay my monthly bills. And I think people in my age group, 30 and up, it's very important that you're debt free and that you set up the next phase of your life, because you're going to have a family and kids. And growing kids cost a lot of money. They're not cheap to not just feed, but then put through school and all that. So, being debt free will give you options that will help not only give you peace in rough times, but also set your family up for generational wealth, which is kind of what the plan is for me. And teaching these same principles to my kids, hoping then they take them and apply them in their life and so forth. But yeah, if you're a young guy, man, you could be as risky as you want to be. And if you lose it all, so what? You just start over again. I started at 27. So, you got 7 years you can play with, Frank, and still probably be all right if you start over again. It's never too late. But yeah, for us older folks, I don't want to put myself in I don't want to piss off the 30-year-olds, but yeah, us 80s kids, we have to have more stability in our life as it continues to progress.
Yeah. Yeah, I agree. So I guess we can move a little bit on to investing. Like where, I guess first of all, just kind of like describe your um, index funds that you hold. I know you
Yeah.
have like three main ones, right?
Yeah. So let me take you back though before I describe where I'm at now. I think it's beneficial to tell you where I was in the beginning when I started. When I started with a Robinhood account in 2018 and $1,000, trying to turn 1,000 into a million. I was not successful, obviously. And I learned a couple of valuable lessons. I learned that playing the stock market like a slot machine is not a good long term approach, because you could look like a genius in the beginning, and I did. I bought a, I think, no, I know my first free share or first free stock on Robinhood was Apple. And back then, man, this was 2018. I think Apple split since then. I don't know if they have or not, but it was trading at like 100. And I'm sure now it's, after the split, it was probably up to 300, 400, whatever the case may be. But
Yeah.
anyways, it doubled quickly on me. In like 6 months, Apple went from 100 to 200 or whatever it was. And I looked like a genius, and it was a free share. And I thought, well, if Apple could do this, why don't I just find the penny stock that is worth $1 and it goes to $100, and I'll be a genius. So, I took some proceeds from Apple. It was free money. And again, a gambler's mindset, and put in some kind of stock. I don't remember what it was now. Of course, the thing, instead of going to 100, it went to like 10 cents. So I said, oh, okay, well, this doesn't work. Let me see this crypto thing. It's open 24/7 on Robinhood. So I bought some Dogecoin before anybody knew what Dogecoin was, and some Bitcoin. And I watched it go up and down, watched it every day. And I'm like, oh, I'm going to buy here when it's like 10 or 0.0001. And now it's 0.0012. I'm going to sell it and then, flip that. And needless to say, after a year of doing that, with that $1,000, I was down to like $200, right? I just wiped myself out. Luckily, I only did it with $1,000, and then I got a tax form that was like 55 pages long, and my accountant goes, "What the heck are you doing?" And I'm like, "I don't know. I was just trying to get rich." That was 2018 when I was still kind of learning about money, and then 2019, I came across John Bogle, or late 2018, I came across John Bogle. I read a book. It was called The Little Book of Common Sense Investing. And John Bogle, I'm sure everybody knows who he is, but the founder of Vanguard and the creator of the original index fund back in 1975. His little red book, I recommend to every investor, whether you're stock picking, index, and whatever the heck you're doing, you should read that book, because it'll show you the secrets of Wall Street. And the secret is, Wall Street's out there to make money, and it's your money they're going to take. And us retail folks just don't know any better. We're like, we're just sitting ducks for Wall Street, right? They pounce, take our money, and then we probably just get out of the stock market as retail investors, never invest again. And then new blood enters, and it's a vicious cycle. But Bogle's book allowed me to see the light with index investing, and I embraced it early on, right away. The first fund I bought was just one fund. It was the Fidelity Total Stock Market Index Fund, FSKX. That was available in my 401k as well as my wife's 401k. And by the end of 2019, we had $100,000 invested in that fund. 80 some thousand was probably the contributions that we made from the 401k, the Roth IRA, and the taxable, and maybe 10 or 12,000 was from the gains. But there and then I realized, okay, well, I just made $12,000 and I didn't have to really worry about it. All I had to worry about was putting money in. But I also learned, I read a whole lot of other books, and I learned that diversification is important, not so much early on, but later on. You don't want to have, as the saying goes, all your eggs in one basket. So I wanted to see what are some other funds. And for most people, like you, for example, in your 20s, a total S&P 500 total U.S. stock market is just fine. It's got a whole lot of stocks, a lot more than any retail investor can put in their individual portfolio, right? You can't own 1,000 stocks, I don't think. It's almost impossible to buy a share of every company out there, but the index fund will do that for you. But I think later on in life, and I'm looking at it from my lens now of somebody in my 30s, when you have a couple of $100,000 invested in the stock market, you start to think, well, what if this one fund does not work out? Not in the long run, but what if it doesn't work out over the next 10, 15 years? Or what if it doesn't work out when I need it to to retire, and it's down. So then I started learning about diversification and the importance of having different asset classes. So not just US, but international, and not just large caps, but small caps. And from that, my strategy that I call now the Monkey 3 was born. And I put in a whole year's worth of research, and not just back testing data, but actually reading to build this strategy. And the strategy is quite simple. If you're familiar with like a Boglehead 3 fund portfolio, I kind of took their idea where I have 60% of the total US stock market. I have 20% in a total international stock market. And then I have 20% in a small cap value. And the small cap value came to me from a gentleman that I had read his material. His name was Paul Merriman. And I never knew anything about small cap value up to that point, but he opened my eyes to it. And I have a great interview on my channel with him. He's been retired for a long time. He has a foundation he runs now and educates investors on the importance of investing. But the small cap value was like a wild card play. I didn't really want to hold a Boglehead 3 fund traditional portfolio with bonds because of how young I am. I think bonds serve a purpose, but not for anybody under the age of 40. So I look to aggressive asset class like small cap value that could be not a lottery ticket, but it could be my wild card, where historically it's done 14% on average versus the S&P, which has done 10. So it's outperformed the S&P since 1926 on a year-by-year basis by 4% a year on average, which is really good. And somebody like me who's got a long time frame, 30 plus years, that outperformance could lead to an extra $1.5 million in retirement, which is even better. So that's where the strategy comes from. It's really simple. It's 3 funds. It's easy to manage. It's easy to rebalance. And the best part is you can sleep at night. And if one fund does well, the other one usually doesn't. And if one does poorly, the other one does well. Like, for example, to start the year, I know the U.S. markets have been beaten up, but small cap value up until recently was only down like 7 or 8%, which is pretty good when the S&P is down 20 and NASDAQ is down 30. It's good to have something that's only down 7, 8%. Same thing with international, although it's been beaten up for the past almost 2 decades now. There will come a time, because it looks so undervalued, there will come a time like the 60s and 70s, early half of 80s, where international just kicked the US's ass year over year for so many years. Eventually, all this thing is cyclical and it just comes back around. So that's the idea. You own 13,000 stocks. You own every stock in the US. You own every stock in the world. You even own some of those small companies nobody's ever heard of that could be tomorrow's future leaders. And some of them will probably never hear from again, which is fine too. When you own them in an index fund, it's one nice thing about index investing versus active management or any other form of investing. It's sort of like a self-cleansing deal where the good companies will rise to the top. The bad companies will slowly whittle away into non-existence. And it doesn't affect the overall performance of the index very much. So you get to benefit from the Teslas and the Apples on their rise, but you don't get hurt by their demises so much in an index fund versus sort of holding them individually. So yeah, that's the approach. Call it the Monkey 3. I couldn't think of a more creative name. And it's now a strategy I deploy in all my accounts: 401ks, IRAs, 529s, UTMAs, HSAs. It's everywhere.
Okay. So I guess why did you choose to diversify at this point in your life as opposed to waiting longer, I guess?
Yeah. That's something that ran across my mind because, right, I'm so young. I could keep buying the US and maybe 10 years away from retirement, get into diversification. But then the more I thought about it, if you can get into something that has historically done 4% better than the US market over a long period of time, it's better that you get into it earlier, right? And that's where small cap value, I need to be in small cap value for 40 years to see a premium, because in the last decade, small cap values underperformed, right? So you have to be in it for a long run to see any kind of premium. So that's why I diversified away pretty early after I crossed the 6-figure mark in my portfolios. I think if I would have waited, I still would be fine. It's not like if you just buy the S&P 500 your whole life and then diversify away 10 years, you're still going to get that 10%, right? But if you're trying to do a little bit of a value tilt, a little bit of a small tilt, you got to do it early and you got to be very, very patient for a long time. And then the international piece was just a hedge. I believe in the U.S. economy and the U.S. markets forever, but I'm also not dumb enough to think that there won't be other countries that might potentially be better than the U.S. Some emerging markets, China, India, some of these countries in the future. We don't know what they'll be. And I wanted to hold that as a hedge just in case the U.S. falls from the top. I'm not stuck in an economy like investors in Japan were, where, Japan was the best economy in the 70s and 80s. And since then, it's been negative for 30 plus years. I wanted to shelter myself from the potential of that happening with a 20% hedge, which tells you I don't really believe it's going to happen, but we don't know what's going to happen. So that's why I went with the international early on as well, just to hedge a little bit against what could potentially happen in the US.
Okay. So
But good question.
yeah, um, when you are investing, do you normally just like dollar cost average for the most part?
Yeah, my philosophy with investing is I have this money, it goes in the market. I don't care what the market is, what it's doing. I call it when you have cash, you buy. So yeah, it's a form of dollar cost averaging, but it's also kind of a form of lump sum investing. A good example, I sold one of my properties last year in June and I netted 80 some $1,000. And I turned around, obviously put some money aside for a future down payment, but turned around and invested like 40,000 just at once. Boom, right into the market. Didn't care what the price was. Looking back on it now, it was at 4,400 was the S&P at the time when I bought. So markets were, obviously that money's down. The markets were a little bit higher, but would I have been better off dollar cost averaging it? Yes, but I didn't know in June of 21 what June of 22 is going to look like. So I try not to play the what if game or second guess this or that because they'll drive you nuts. So my philosophy when I have the cash and it's earmarked for investing, I invested that day or the next day the market's open. And I don't look back and, ponder, oh, what if? Because the market goes up 75% of the time, it goes down 25% of the time. So that means 3 out of the 4 times you invest, that dollar that you invested is going to be more in the future than it's going to be less. So it's a loser's game to focus on, I guess, the dollar cost averaging and saying, I will only do this much and I will sit in cash and I will pick my better buying opportunities because most times those don't come. I know it's me saying it now when they're here and the times are here, but usually it's not like this. Trust me. Usually it works the other way where the market runs away from you. So yeah, I believe in the philosophy of lump sum investing and investing as soon as you have it. But yeah, it's a form of dollar cost averaging. Like with the 401ks, for example, we invest every paycheck a set amount. So that's dollar cost averaging, but everything else is whenever I have it, boom, the money goes in.
Okay. And are you like doing anything different right now? Are you trying to like find more cash to throw at the market
Yes.
or?
You know what's funny? So every time there's been a downturn, I'm always short on money. I don't know why it works like that, but it does. Like I mentioned, I quit my job in March of 21. So obviously we went from 175,000 a year to now 90,000 a year, which is a huge pay cut. And YouTube money's dried up with the birth of my kid, even my coaching business. I stopped taking on new clients. It's time consuming, right? To be actively trying to get more clients and all that. So long story short, my income's dried up and the market goes down and I don't got money to invest. So yeah, I'm scrambling, trying to see what I can sell on Facebook Marketplace to get some extra money. I sold a couch recently and stuff like that. But yeah, the problem is you always need more money, right? But I'm not doing anything different. It's right now I've set myself up with well, now it's dropped a lot, but it was a $310,000 portfolio. I think now it's a $250,000 portfolio. If I just left this thing alone and literally never put another dollar in it, it's going to be worth 4.85 million at age 65. So I'm okay either way. It's not going to make or break me that I don't get to buy the dip in this 20% drop, but yeah, I think every investor wishes they had more money when times are like this, where a lot of stuff is looking to be at a good deal. But I think the reason the prices fall is because well, I don't know if this is the case now. We'll see with these recession talks. But when the economy turns and market crashes, usually people are losing their jobs and getting laid off, so they don't have money to invest in the first place. So it's always that conundrum of markets down, but you don't have the money to buy the dip because you either bought previous dips or maybe you're low on cash and inflation's kicked up and you're paying too much at the pump or too much at the grocery store, whatever the case may be. But yeah, nothing different, man. Everything's the same, except I'm living on less, which I know how to do now thanks to being debt free and all that, not borrowing money. So it doesn't phase me. And it is a little risky in the sense that we're relying heavily on my wife's income, which is, again, she's in financial services as well. And if something were to happen there, it's risky, but I have a cushy taxable account, almost $70,000 in there, which could easily support us for a year while we figure it out. So, but yeah, nothing's changed. Everything's pushing forward just like always.
Yeah, I definitely like. I manage just like a little bit of investments for my brother, and
Nice.
I texted him the other day and was like telling him I basically like he deposits like a set amount like every month or whatever, and I said I like used up all that, and so he like deposited some more money, and then within like a day I like spent like half of it. I'm like, oh geez, this you can go pretty quickly through this.
I think of I always think of that South Park scene where I don't know if you're familiar with it. They go to the bank and the guy's like, you should open an investment account, and then he opens it up and he's like, oh, okay, all your money's gone. Now, if you want to keep investing, you got to invest some more. And he's like, this line's only for customers only, and like kicks him out of line but yeah, it's how old's your brother that you're investing for him? Is he younger than you?
No, he's just like a few years older.
Okay, he doesn't want to
Like 3 years older.
learn on his own.
Well, he like does some stuff on his own, but more
he
like
trusts you.
Individual stocks.
Gotcha.
Him, I guess.
Gotcha. Yeah.
And again, like for him, like what I'm investing for him is not like super significant at this point.
Yeah, it's not going to be life-changing money. Yeah, but yeah, I always think of that South Park whenever I've had a few people approach me, like friends and family members, and ask my recommendations on stocks and whatever, and I always tell them no as far as stocks. But yeah, I'll tell them put your money in this fund as far as mutual index funds, and this is what it's going to do. And in the short term, it could lose you half. And if you're not okay with your $100 going to 50, then you probably shouldn't be investing, because then later on, when you actually have some money in investments, it's going to be more like it's going to go from 100,000 to 50,000.
Yeah.
And if you can't handle 100 going to 50, you're not going to handle 100,000 going to 50,000. So you should go look for safer, and that's fine too. Some people can't, and they should seek safer investment options. But that's pretty cool, man, that you're kind of helping him out there, and hopefully he gets interested in himself too. And what kind of stocks are you buying for him?
Honestly, mostly like the same stuff I buy for myself, which is just like dividend stocks.
Dividend stock, okay.
Like more blue chip stuff.
Gotcha.
So
why are you buying dividend stocks?
What do you mean?
What are you buying them for? At 20 years old, why are you buying them?
Well, I guess for me, like the thing that attracts me to dividend stocks, I guess, is the fact that you're realizing some of your returns like slowly over time.
Mm-hmm.
And like if you just buy like an Amazon or whatever, it's a great company, and I own some Amazon, but it's like you buy it and then the only way you make money is by selling it some other time.
Yeah.
And
you need the price of Amazon to be higher than what you paid for it.
Yeah.
Versus
and also like
go ahead, I'm sorry.
Everyone is always saying like buy and hold, buy and hold, buy and hold, right? And never sell. But like eventually, if you want to use this money at some point, you have to sell it, right?
Correct.
So for me, I sort of see the dividend as like, I guess not necessarily a solution to that, but just like a different way of going about it. And people will say like you should be doing something more risky when you're young, and stuff like that. But at the same time, I feel like if you build up a solid foundation when you're young, then you just have that much more time for that to compound. And yeah, I could try to find like something that's gonna, like 10x in 5 years, but the probability of that happening is like low. And so I could just go. I just feel like a slow and steady strategy is like suits me better at least.
Yeah.
So
Yeah. I mean, I have a different take on dividend investing. Not to, I think what you're doing is fine as long as you're buying and holding, but there is a more effective way of doing it. So the thing with dividend, and are most of your dividend stocks in tax protected accounts, or are they kind of a mixture of taxable and tax protected?
no, I mean the only dividend stocks I own in like tax protected accounts are REITs, but
So you have like these blue chip large value dividend stocks in taxable accounts too.
yeah,
Yeah. So here's the thing with that, right? That dividend that gets paid to you quarterly or semi-annually, whatever it is, you're going to owe taxes on it, right? Even if it's qualified
yeah,
at a
yeah,
lower rate at 15%. But what that inherently does, it creates a drag on your performance over the long run. So it's true you're compounding, but you're also compounding your tax. So you're the study that I read, I'm trying to figure out who did this study, but they took a look at some of the biggest like blue chip names, like the Johnson Johnsons, the Pepsis, and all that. And when you factor in a 15% tax rate on those dividends, you were underperforming the S&P 500. Now, yes, you're compounding, but you're also compounding, like I mentioned, the tax drag. So it's about a 2% tax drag that it creates over a long time frame on your performance. Which it's again, it's not the end of the world, but how do I say this? You could be better served, in my opinion, focusing. And I know your explanation was, well, if you buy Amazon, you can only hope that the price goes up, right? You're not going to collect any cash flows from it, which is true. But if you focused on more of lower dividend growth stocks early on in taxable, not in tax protected, you could do. It doesn't matter. These dividend tax drags don't happen in taxable tax protected accounts, but in taxable accounts, if you focus on a lower yield on your portfolio, generally that higher growth will or the lower yield will save you a lot in taxes going forward. I know now, I don't know how big your portfolio is. It probably won't matter in your 20s, but maybe in your 30s and 40s, you'll see that income will create a drag. And I used to follow a dividend growth investing strategy in a little side account that I had. It was a taxable account until I came to this realization that one, my stocks were underperforming over a long period of time, like the AT&Ts of the world. Like if you buy and hold them, I think since 95, AT&T's returned 3% a year on average. That's like what the bonds have done, right? So it's not that great. And AT&T was, I know now it's not as big of a powerhouse, but it was a top 10 play in the S&P 500 in the 50s. I mean, not the 50s, the 1995s, the 2000s era. And just historically over time, these are good companies to hold. They're not like the Amazons and the Teslas that either go kaboom or they go to the moon. These are very stable companies that you can compound over time, but at the same time, I think it's not the most effective strategy. But it doesn't mean that it's not the right strategy for you. It seems to work for you. You seem to understand it really well, and you're comfortable with it. And I think giving up some performance in your 20s might hurt you in the long run, but if it gives you that peace of mind that I mentioned earlier, that's all that matters. It's like the same thing. Well, me not having credit cards and borrowing money could hurt me, because I can't grow my wealth as fast. Some people might say the peace of mind that it gives me is greater than any of that. So pretty interesting. Not a lot of young people are doing dividend growth investing. They're doing the pick the next 10x stocks. So that's good on you that you've understood the power of compound growth and you've seen that through dividends. And I'm glad it's working for you.
yeah. I think that's definitely a good point. And like for me at this point, something that's not, I guess I would say not a consideration because of my low income, right? So
Mm-hmm.
like it's not even the 15% for me, right?
Yeah.
Um, And
Yeah,
so
if you
that's
have,
I
yeah.
think that's definitely something to consider. Um,
But
and
eventually you're gonna, because these dividends uh will be part of your income, right, in the future.
yeah,
So once you get a career established and you start making more money, the name of the game is going to be, how do I pay the least amount of taxes?
yeah,
For example, me, I tax protect most of my money to get to myself the lowest tax bracket humanly possible, legally possible, I should say. And I hate dividends because they I have to pay taxes and they bump up my income, right? Because they're considered as part of my income. And I, at least in taxable accounts, again, I always seek like the lowest yield possible so that I'm not getting bumped into the next tax bracket. I think dividends serve a purpose for people who are older in life and are looking to retire and actually use them. But if you're just getting them and then reinvesting them, it's not extra money in a sense, because those dividends were paid out from the profits of the business. So it's not like the business got richer overnight. It simply took the cash flow and gave it to you, the investor, instead of reinvested it into whatever the business does. And then it leaves you on the hook for the taxes, which I think somebody who makes like 150,000 and up will probably see that's not very beneficial, because then it'll just keep bumping them up in their tax bracket every year, especially if they start building a dividend growth portfolio in a taxable account that's, six figures, 250,000, 500,000. It starts to become very tax inefficient. But yeah, that's neither here nor there. It's a small little
yeah,
detail. And the good news is you're 20 and investing. and
yeah,
and if you stick with the philosophy that you have, you're going to be very, very successful.
yeah. And also, like, I've been investing, for 2 years or so, right? And just over that time period, like, I can see my investing strategies have like changed drastically. And,
Hmm.
a lot of that is like a learning curve type thing where I just didn't know anything at the beginning, right? Um, but at the same time, like, there's nothing to say that like there's not more efficient ways to go about it, and
Yeah.
that I'm set in stone here
Yeah,
with
of
what I'm
course.
doing.
Yeah, I
So
think we're all. I'm pretty rigid now. I don't move. I am like a rock. But when I was younger, a couple of years ago, and still learning about this stuff, I tried everything because I wanted to educate myself by doing it. Now, I think one of the mistakes that we make is we don't give any strategy enough time to play out, right? So, like, for example, if you're a dividend growth investor, you shouldn't be looking in the last 5 or 10 years to see if that strategy works. You got to really give it like 20, 30, 40 years for that compounding effect to take place. So it's like a huge trial and error for 30 years. And if you're wrong at the end of 30 years, then you have less money. And I always early on pick the strategy, and then like 3 months later, well, I'm going to try something else. This is not working, right? And then you just start trying different things. But eventually what I figured out is, with index investing, what's unique, and I'm sure with the index funds you own, is um, it tends to be the best strategy over the long run. So 2 years, so you've been investing, is not long enough, but you've probably seen that most of the index funds you own have done better in performance. Probably maybe your dividend stocks have done better this year because of the shift to value. But what you'll see is most of the things you try underperform the index, and there's a reason for that. The index is made up of the average of every investor. So institutional and retail combined make up the average of the index, and that's what the market price is. And most people cannot do better than average. Most people do worse than average, and it makes sense, right? You're trading as an investor. You're trading with somebody else. So somebody else is selling you, I don't know, dividend stock that they think is reached its potential, and you're buying it because you see a future in growth in that stock. And there's millions of these trades happening back and forth every day, and you sum them all up and you divide them by the volume, and that's what you get, the average. And the problem with that is none of us, again, are gonna do better than average. So it's best to just be average when it comes to investing, because you will outperform over the long run the majority of people on tax efficiency, on trading costs and fees. Even though now I don't think it costs you anything to buy your stocks, right? If you're using one of the big platforms. You can do it for free, so that the costs are not so much a factor, but the tax inefficiencies and then the underperformance of the actual stocks are the factor, where over the long run, you'll see that most of the index funds that you hold will probably do better. But that's not to say that's a guarantee. You never know what's going to happen in the future, but that's at least how it's been in the past, and kind of how I came into embracing index investing, is knowing that I'm not better than the average person. I'm not smarter than them. As much as I try and study and read this stuff, I'm not a Warren Buffett. There's only one of those. And one other point I want to touch on is investing is interesting. It's like it. Let me ask you an open-ended question. I'm always curious when I ask. What do you think constitutes a good investor in your eyes? Like, how do you know somebody's a good investor?
I guess someone that has like maybe like defined goals of what they're trying to achieve. I think that's
Yeah, but
definitely
on
a
a,
big
I'm
part of
saying
it.
on a metrics level, how do you measure whether someone, like, here you are and here I am? How can somebody watching us say which one of us is the better investor? Like, what's the metrics? Is it the value
Yeah,
of our portfolios? Is it our performance? What is it that makes somebody a good investor and somebody a bad investor?
I would say like your performance
Yeah,
over
over
whatever
a
time
period of
period you
time.
choose.
So here's the
And
funny part, right? So I've outperformed Kathy Wood. Does that mean I'm a better investor than Kathy Wood? Probably not, right? But if you look at it on a performance level, heck, even if you want to look at performance, a lot of people have outperformed Warren Buffett in the last 10 years. Are they better than Warren
yeah,
Buffett? No way, they're not. So I think investing, it's hard to say what makes a good investor, because it's very luck driven. It's very time sensitive, meaning if you got in the right thing at the right time, you could look like a good investor. But the skill that you use to do that is not something you could replicate. Versus, let's say, me and LeBron James get on the basketball court, right? You can easily say, well, LeBron James is a better basketball player than me by looking at his skill set and when he's shooting versus when I'm shooting or handling the ball, right? It's a skill that can be measured. In investing, there is no such skill that I've found yet that I can measure and say this is a skill set that a good investor uses. Now, some of the things you mentioned are great. Yeah, you want to have good performance. You want to have sound investments, which, you know, a lot of good investors do have, but it still does not mean that they can be better than the market. And it usually pans out that they're not. A lot of the research supports that fund managers, which are professional money managers, people that do it for a living, um, they underperform the index, right? So if these guys underperform and they're Harvard grads, some of the most skilled in analytics and understand, they live on Wall Street, they understand everything, and they underperform, it really makes it very difficult for us to even have a fighting chance in whatever strategy we implement. So that's why I've kind of stuck my guns with this index investing strategy since 2019 and haven't ventured off into any other strategy like I did before, just because I know I don't have the skill set, and nobody does really, to do this for a long time and to do it really well outside of just buying the dang market and riding the ups and downs of the market.
yeah, that's actually something I was gonna bring up. Is like it's difficult to like actually like determine to some point if you really are beating the market or not,
Yeah.
because like you can look at the value of your portfolio from like a certain time to a certain time and compare it to the market, but then you have to like it's very difficult like mathematically taking into account all your contributions and stuff like that.
Yeah.
And so that's where it's almost difficult to even like determine those performance metrics.
Correct. It's difficult because your um buying times are different than when you might buy on a Friday, I'll buy on a Tuesday. So your price that you bought in, the price I bought in, is completely different. And then when you factor in how many buys you do, um, to get an average on that, you can still get an average and understand that, okay, I've put in
Yeah.
X amount of dollars and now my portfolio is worth this. So you know how much you have in gains and you can determine what your average rate of return has been. I know a lot of platforms will calculate it for you, but the way I do it, I take money weight out of the equation because it's such a huge variable, and I might put in $1,000 this week, and somebody else might put in 10. Right. So that's not if you money weight our returns, it's not a really fair metric to use, because my portfolio might be much more weighted to this buy that I did for $1,000 than somebody who only did a $10 buy. But if you look at time weighted returns of an investment, whether it's a index fund or a stock, you can at least get a better picture of what that time weighted return looks like. And if you're dollar cost averaging, more than likely you will have whatever that time weighted return is. That's what because you're going to be buying up here, buying down here, and everywhere along the way, which will make 12 buys a year, or however many buys you do, will average out to whatever the time weighted return of that investment is. So it is easy to calculate at the end of the day, and I think you can probably see. I don't know what platforms you use, but you could probably see you can see all time data on your returns, and then you just pull up whatever benchmark you want to. I think if you're primarily dividend investing, you should bench yourself to a large cap value fund, like a large cap value index, and see how well you've done. And if you're underperforming that index in over the last 2 years, it's not really long enough to determine if you're good or bad. But let's say over the next 5 or 10 years, if you underperform a large cap value index, it might be more prudent for you just to buy the dang large cap value index. I know a lot of them now have a dividend yield of somewhere 3.5–4%, if that's what you're after, and they tend to be very stable in times where it's rough, but they also don't go up a lot in times where growth is in favor. But over the long run, large cap value does do well. Those indexes, they do well. They actually outperform the market, just because they hold a lot of undervalued, beaten up stocks. But I can't say as individual picks what your stocks would or won't do over the long run. But historically, there's not a lot of them, because those indexes are still technically managing, even though it's passively managed through the index, they're still booting companies in and out of the index based off certain factors. Some of them have like a profitability factor on there that they put. There's, I don't know, over 400 factors now that you can rate companies on. So there's all this complex stuff that indexes do that we as individual investors who just buy and hold, we're not kind of doing that, right? You're not screening your companies. I'm sure you are, but a lot of people are not screening their companies and saying, well, profitability score looks really bad over the last trailing 12 months. So I'm going to boot this company. And, it's more of an active approach, but indexes do it for you, which makes it nice and easy and passive, and still gets you the dividend yield that you seek, and potentially get you even some outperformance in the long run. But yeah, that's something I'd challenge you to do over the next 5 to 10 years, and just see how you stack up. And if you do better, great. And if you see that you're not doing so well, maybe it's something you think about. Not trying to sway you one way or another, but it's best when everybody comes to their own conclusions, because then they tend to believe in it more, right? Like, nobody can push me off the Moki 3 ever again, because I created it and I believe in it so much. And it's like a hill that I stand on. I'm willing to die on this hill for the strategy that I deploy now. So it's always best when you come to your own conclusions.
Yeah. And I mean, like I said, I think I said this before, like most of my investments are just in like the total stock market index. Mm-hmm. So I guess in terms of the dividend stocks, it's almost like something that I just enjoy doing. And I feel like to some degree that's almost like a bad thing, because I just enjoy like looking at companies and learning about them and all that kind of stuff. So it's almost like, if I'm like doing poorly, will I be able to recognize that and just say, well, this is not worth my time, even though it's, maybe something I enjoy.
Yeah.
I guess that's something that's in my mind a little bit that could be an issue.
Yeah. Another thing I'll tell you is I enjoyed it too. I really did, until I got strapped for time, until, family comes first and all these other obligations. And now I'm like trying to make time just to do a 1 hour live stream, right? Like I got no time. So when you get later on strapped for time in life, I think you'll come to your own conclusions, whether it's worth it or not. Like for me now, I'd rather put on the baseball game than go research companies. But I know me in the past would rather research companies than, do other stuff. So it really, nobody can answer if it's a good or bad use of your time. If you enjoy it, you enjoy it. Who cares? I like to read a book or watch a baseball game. You like to research stocks. It's great. It's where your passion is. So as long as you have the time and it's your passion, I don't see a problem with it. Will it lead to outperformance? Probably not. But that's not why you do it. You do it because you truly enjoy it, and you get some kind of satisfaction from that, which is important to have. Whatever you do that you enjoy, it keeps you happy. It's a good motivator in life to keep going and keep pushing forward and learning more. Um, you know, Always keep your mind open, always keep learning new things and keep growing, and never, I guess, never stay content in the sense of like, I know everything, because you never do. There's always new stuff to
Yeah.
learn. So yeah, that's pretty cool that you
Yeah.
enjoy it. And I know a lot of people do that are in this space, that otherwise we wouldn't have YouTube channels about investing and money, right? If we didn't enjoy this stuff. So
Yeah.
uh, I just don't enjoy it on an individual company level any longer, just primarily because I don't have time, and I kind of lost hope when I kept coming across the data that supported that. It's very difficult to do. It's extremely difficult to do
Yeah.
as far as picking them where you outperform. You can pick them and be successful, right? And just
Yeah.
because you underperform doesn't mean you're not successful. You're still going to have money in retirement to spend. You just will have less than if you went, the index route usually, but doesn't mean that will be your case. And I'm just excited. My biggest thing that I'm excited for is you're 20 and you're doing this. That's like the most important thing, right? Because I use this thing called a wealth multiplier. I don't know how we're doing on time. 1 hour. How long do you usually run
Yeah.
these?
Usually about an hour, but we
Okay,
can
I'll
keep
wrap
going with
I'll wrap
whatever
it
you were
up. I'll
saying.
wrap it up.
Yeah, that's fine.
Yeah, this will be my last point. So I use this thing called a wealth multiplier, and it basically assigns a number that you can multiply your portfolio at your age to know what it's going to be worth at age 65. So I'm just going to pull up the wealth multiplier for your age. So it's 88. So if you just take your portfolio value today and you multiply it by that number, 88, um, that number that you get is going to be approximately, obviously not to a T, but approximately what your portfolio is going to be worth when you're 65 years old. So your wealth multiplier is the highest it will ever be in your entire life. For example, I'm 32, about to be 33. My wealth multiplier is only 16. So that means look at how much in 12 years you lose in the ability to multiply your wealth. So the biggest secret, or the biggest takeaway is not if you're an index or dividend or this or that. It's that you're 20 years old and that you're investing, because these dollars that you put to work today will be the hardest working dollars you will ever deploy the rest of your life. And that's what's going to make you successful. And that's what I'm excited about for you the most. Not any of the other nuances of what you're buying or who cares what the price is. A lot of that is irrelevant in the grand scheme of things. It's really about
Yeah.
time and understanding the power of the money that you invest at such a young age, what it can become.
Yeah. I guess I'll say I really appreciate that you say that, because I think it's something I need to think about more. Because sometimes I get in the mindset of, well, what I'm doing now doesn't really matter because I'm contributing very small amounts,
Oh, it
whereas in the
matters.
future I'll be contributing a lot more.
Well,
And like that is, I know like what you said is true,
yeah.
but I just need to like think about that more.
Here, I'll end it like this. So all you have to do right now is contribute $95 a month to become a millionaire at age 65. Okay. At my age, 33 or 32, going on 33, I got to do $367 a month. Right. So the idea of, yeah, I'll contribute more later on is baloney, because you have to contribute almost 3 times as much to still have just $1 million. Right. So you starting at 20, only doing $95 a month gets you at 1 million. Me starting at 32, 33, having to do 3 times as much as you, and I still only get to 1 million. It matters. So even if it's $10, $20, whatever you scrape up, it matters, because it's less that you're going to have to do in the future. Kind of like where I'm at now. I did a lot of my early investing when I was 28, 29, 30. I'm sorry, 28, 29, 30, 31. And now at 32, I backed off a little bit, partly because I don't have the money anymore like I used to. That money that I put in had wealth multipliers, I think, in the 30s and in the mid 20s, versus now it's only 16. So that money will grow to crazy amounts. I mentioned earlier, 4.85 million, or in that ballpark. Even if I'm $600,000 off, I'm still a freaking multimillionaire, so it won't matter. But that money will grow into something so much more than if now, let's say I got my life together, and the next, at age 35, I started doing like $2,000 or $3,000 a month. I'll never be able to catch up than me at 27 doing how much I did. So don't be discouraged. And this is where that mindset of, when you have the cash, deploy it, don't think about it, is going to pay off, because it's really going to be the early years. The statistic that I read for 20-year-olds, I think 75% of the value, or no, I'm sorry, 65% of the value of your portfolio in retirement will come from the first quarter of your investing life. So from age, let's say you're investing for 40 years, from age 20 to age 30, 75% of the value of your, or 65% of the value of your portfolio in retirement will come from those first 10 years. That's very powerful stuff. That is the hardest working money. Even if it's small amounts. I know it's small amounts today, but think about just the doubling effect. It takes 7 years for an average portfolio to double. How many doubling life cycles are you going to have of that money? And when you turn $100 into 200, 200 into 400, 400 to 800, 800 into 1600, the numbers start getting bigger and bigger. And every dollar you invest will do that doubling many times over. In many bull runs and many bear markets, it won't matter. At the end, that will be the hardest working money. So don't, I know it's hard because you always like, I'm going to have more to invest later on, but you're really going to be behind the 8 ball later on, which is kind of a secret a lot of people don't know, is if you can do it early, you're going to set yourself up for a much easier life, a much more successful life, than if you wait to do it later on in life.
Yeah, that makes sense. And like you said, you're gonna have a lot more expenses later too once you have a
Trust
family
me
and
on
stuff.
that. Trust me on that, man. It doesn't get easier. I promise you. I wish I think anybody that is in my age group wishes they go back to their 20s and just knock themselves in the head and put away $100 into an investment account and be like, just do it, you doofus. But in my 20s, it was all about partying and chicks, and I guess I'm paying for it in the back end of my life now as a family man, having to scrap money together to invest. But hey, I'm not complaining. I'm doing all right. I thank God for all the blessings and all that. And just continue to drive the message forward, and really try to reach out to people like you. I'm so glad you reached out to me, and I'll make sure we keep in contact. But in your age group, man, hopefully your audience is as young as you, because I attract a little bit of older audience with the stuff I talk about. If they could just understand that and not worry so much about the investment aspect, but understand the contribution aspect, they would do so much better in their investing lifetimes. But people get tied up in the nuances of investing and arguing back and forth of what's right, what's wrong, which is the wrong thing to argue about. In my opinion, it should be how much money you're contributing and at what age you're starting. But thanks for the conversation tonight, Frank. It's been fun, man. I always love when I have some free time to chat it up. And however you want to close it off, you let me know.
Yeah, thank you so much. I really appreciate you taking the time. And I think I put your YouTube channel and stuff in the description. Is there anything else like you want to tell people about?
I appreciate that. I put out a little community post. Hopefully some of my followers jump on board and support your message. But no, man, thanks for inviting me and having this conversation and being super chill about it. It's kind of rare in this day and age of people talking without ripping their heads off, each other's heads off. So that's cool that you're open-minded. I think they'll get you far in life, and just keep pushing forward and learn from other people's mistakes as much as you can, because that's always cheaper than making your own. But sometimes if you have to make your own, some of those lessons could be very valuable that will stick with you for a lifetime. And never be discouraged by a balance on the screen. I think you should be encouraged by all the other things like your age and the bright future you have for you. And the fact that you have any money set aside is freaking really impressive. So thanks again, man. And to all the viewers out there, thanks for watching, guys. And hopefully we'll do one of these again in the future. And I'd like to see your channel grow and you continuing to spread the good message.
Yeah, for sure. Thank you so much for your time. And again, thanks for everyone for watching. I really appreciate it. We'll see you next time. Bye.